Welcome to the deep dive. When you think about fields steeped in tradition, auditing often comes to mind.
Oh, definitely. Ledgers, calculators, maybe a
Okay.
magnifying glass.
Exactly. But what if I told you that this seemingly staid world is actually undergoing a massive high-tech transformation?
I'd say I've seen it happening.
Imagine not just uncovering financial secrets with that magnifying glass, but with cutting-edge data tools that can scan, entire oceans of information in seconds.
It's pretty incredible stuff.
That's right. We're talking about a quiet revolution, and today we're going to pull back the curtain on how auditors are leveraging vast amounts of data and advanced technology to gain incredibly deep insights and, well, dramatically enhance audit quality.
It truly is a fascinating evolution. We're moving beyond a world of, let's say, educated guesses and limited sampling
Right.
into an era where comprehensive, data-driven analysis isn't just a possibility, but honestly, it's fast becoming the expected standard. It's genuinely exhilarating to witness.
Absolutely. So our mission for you today is to demystify audit data analytics, or ADAs as they're known.
Yep, 80 days.
We're going to break down exactly what they are, how they're applied in the real world, the powerful tools and clever techniques involved, and why they're genuinely revolutionizing the auditing profession.
Think of us as your guides on this.
Exactly. Think of us as your expert guides, navigating this intricate landscape step by step, making even the most complex concepts, hopefully, incredibly easy to grasp. So settle in, because we're about to take a deep dive into the data-driven world of modern auditing. All right, let's peel back the first layer of this onion. What exactly are we talking about when we say audit data analytics? And perhaps more importantly, why now? Why is this the moment for them to shine?
Okay, so at its core, when we refer to ADAs, we're talking about sophisticated data analytic techniques. These are advanced methods auditors use to meticulously analyze both financial and, importantly, non-financial data.
Non-financial too. Interesting.
Oh, yeah. And the goal is very specific, very powerful. To uncover patterns, reveal hidden relationships, maybe things that weren't obvious before, and pinpoint anomalies during an audit.
It's like equipping auditors with X-ray vision into a company's entire financial ecosystem.
That's a great way to put it. And what's truly fascinating here is the why now. You see, the explosion of information technology, IT, has permeated, well, virtually every corner of business today.
It's everywhere.
It really is. And this isn't just a slow trickle, it's a flood. We're witnessing a massive increase in both the sheer volume and the immediate availability of data. Companies are generating information at an unprecedented rate.
From every click, every transaction.
Exactly. From every single transaction that hits their ledger to every customer interaction, every login, every supply chain movement. And this surge in data has perfectly coincided with significant rapid improvements in auditing technology and our analytic capabilities.
Oh, so the tools cut up with the data flood.
Precisely. So it's not simply that auditors have more data, it's that they finally have smarter, more powerful ways to leverage that data. This confluence of factors has fundamentally changed how an audit is performed. We're shifting from traditional limited sample testing,
The old way.
right, the old way, to far more comprehensive, data-driven approaches.
That's a crucial point. Because more data can actually just mean more noise if you don't have the right approach, right?
Absolutely, you can drown in it.
So how do we prevent that? Where do these powerful ADAs actually plug into the existing audit process? Are we talking about some specialized tool for niche cases, or is it more integrated?
Great question. And no, this isn't a niche tool at all. That's key. If we connect this to the bigger picture, ADAs can be applied right from the very beginning of an audit.
From day one.
Pretty much. They're becoming absolutely essential for performing risk assessment procedures, helping auditors not just identify known dangers, but uncover potential material misstatements in places they might never have even looked before.
Finding hidden risks.
Exactly. They're also critical for tests of controls, allowing auditors to efficiently verify if internal safeguards and processes are actually functioning as they're supposed to.
Checking the safety nets are working.
You got it. And they are invaluable for substantive procedures. That's the real meat and potatoes of verifying the accuracy and completeness of financial statement balances and disclosures.
The core verification part.
Right. And finally, all these insights provide powerful support when forming the overall conclusion of an audit, adding that final, robust layer of comfort, getting that sign-off confidence.
And here's where it gets really interesting. From an efficiency perspective, I imagine. Designing one analysis and getting evidence for multiple parts of the audit at once.
That's a huge perk. It's an inherent efficiency benefit built right into ADAs. You could, for instance, design a single ADA that helps with both your initial risk assessment and then later provides substantive evidence as long as you meet both objectives clearly.
Wow, okay. That sounds like a massive time and effort saver, streamlining things significantly.
It really is.
Yeah.
Which raises the bigger question, why does this all matter? For the auditor, for the client, for the financial markets, the game-changing benefits of ADAs are truly transformative.
Okay, so what's the headline benefit?
The overarching benefit, the one that ties everything together, is a dramatic enhancement of audit quality. And I don't just mean a slight improvement. Auditors gain a much deeper, more nuanced understanding of their clients and their complex operations.
Moving from that blurry photograph to high definition, like you said before.
Exactly. That X-ray vision analogy really holds up, providing clarity you just couldn't achieve before.
Does that deeper understanding mean auditors are spotting risks differently? Maybe even predicting them?
That's a great way to think about it. With that deeper understanding comes advanced risk assessment. Auditors can uncover risks that might have previously gone completely undiscovered. Think of it like finding that tiny, almost invisible crack in the foundation before it becomes a major structural problem.
Proactive, not just reactive.
Precisely. And this is a huge leap from traditional auditing, which, by necessity, often relied heavily on sampling. With ADs, you can achieve expanded audit coverage. You can test entire populations of data.
The whole data set.
The whole thing, not just small representative samples. Imagine, instead of looking at, say, 100 invoices out of 10,000, you can analyze all 10,000.
That's mind-boggling assurance.
It really is. It offers a level of comprehensive assurance that was previously impractical, sometimes even impossible. It's a paradigm shift from sort of sampling guesswork to total clarity. It fundamentally changes what assurance even means in some contexts.
So it's like going from taking a tiny sip from a glass to, well, maybe not draining the whole ocean, but certainly analyzing a much, much bigger sample of it.
A very good analogy. And beyond just the raw numbers, ADAs provide incredibly rich insights. They do this by evaluating metadata, that's data about data, and by analyzing the intricate relationships among different data points.
So connecting the dots in new ways.
Exactly. Whether those data points are internal to the client firm or from external sources. This allows for a far more holistic and contextual view. And all of this, naturally, leads to significantly increased efficiency of the procedures themselves.
Right, because you're automating analysis that used to be manual.
Yes, auditors can streamline and speed up many tasks that were previously manual, repetitive, and incredibly time-consuming. And a critical benefit, one that resonates deeply in today's financial world, is enhanced fraud detection.
Ah, the big one.
Yeah. When you can analyze every single transaction, look for every tiny anomaly, it becomes exponentially harder for fraud to hide in the cracks.
Makes sense. Harder to conceal things when the entire data set is under scrutiny.
Definitely. And finally, because raw data, especially these massive data sets, can be incredibly complex and sometimes overwhelming, ADAs vastly improve communication.
How so?
Through intuitive data visualizations and other consensus reports, these transform complex findings into clear, compelling stories. Think charts, graphs.
Making it easy to see the point.
Exactly. Making it easy to understand for everyone, from the audit team themselves to the client stakeholders, the board, management. It's about translating raw data into actionable insights that really stick, ensuring everyone is truly on the same page.
So we've just painted a pretty compelling picture of what ADAs are and why they're so powerful. But how do we actually do this? What are the practical steps? It sounds like it can't just be about plugging data into some kind of black box, right? There has to be a method.
Oh, absolutely not. It's far from a black box. Think of it this way. Applying ADAs isn't just, plugging numbers into a machine and hoping for the best. It's a meticulous, almost scientific investigation. You need to ensure every insight is robust and reliable.
Okay, so what's the process?
It really boils down to 5 crucial systematic steps. First, and this is absolutely foundational, you plan the ADA.
Plan first, execute later. Makes sense.
Right. This means determining the clear objective and purpose of your analysis. What exactly are we trying to find here? Which parts of the company, which accounts, are we testing? This step also includes assessing precisely what specific data is needed.
You need the right data.
The right data, selecting the most appropriate ADA technique for that objective, deciding which tools will be used and what outputs we realistically expect for assessing the outcome. It's like drawing the detailed blueprint for your data investigation before you even touch a single piece of data.
Got it. Blueprint first. What's next?
Once you have that detailed blueprint, step 2 is to access and obtain the data. This is about getting the right data from the right source. It often involves auditors gaining secure access to various client information systems.
Which can be tricky sometimes, I imagine.
They can be, yeah.
Yeah.
Security, permissions, and then meticulously cleaning and validating the data extraction. You have to ensure it's usable, complete, and free from corruption. Think of it as preparing all your ingredients with precision before you even start cooking.
Okay, prepping the data. Step 3.
Step 3 follows directly. You need to review and analyze the relevance and reliability of the source data. Even if you've extracted it cleanly, you have to rigorously double-check.
Hold on, didn't we just validate it?
We validated the extraction, now we check the data itself. Is this data actually useful for our objective? Can we trust it? Is it accurate and reliable enough to base our audit conclusions on? You wouldn't build a skyscraper on a shaky foundation, right?
Good point. Can't trust the analysis if the data's bad.
Exactly! Same principle applies here. This is a critical quality check.
Absolutely. And only once that data is confirmed as clean and reliable do we move to step 4, perform the ADA.
Now, the fun part.
This is where the actual execution happens, using the selected tools and techniques. This is where the magic truly starts to unfold, as the software sifts through massive data sets, processes them, and reveals the patterns and anomalies you're looking for.
And finally, step 5 is crucial. Evaluate and address the outcomes. Did we achieve our objective? Was the ADA performed effectively? Did it provide meaningful evidence? What does the output actually tell us?
So, interpreting the results.
Right. And this process is often iterative. You might discover that the technique or its performance or even the underlying data needs refinement. That could lead to further procedures or even a rerun of the ADA with adjustments. It's a continuous cycle. Discover, adjust, refine until you gain sufficient assurance.
Okay, that 5-step process makes sense. Now, let's talk about the tools. You mentioned specialized software. What's in the auditor's digital toolbox these days? Doing this manually sounds impossible for large data sets.
Oh, incredibly tedious and wildly inefficient, yeah. For modern audits, software is essential. These tools generally fall into 3 powerful categories.
Okay, category 1.
The first category is data extracts and preparation software, often referred to as ETL tools. That stands for extract, transform, and load.
ETL. Got it.
Their primary purpose is exactly that. Get data out of various client sources, clean and prepare it for analysis, that's the transform part, and then load it into a format suitable for those analyses. It's like the meticulous kitchen prep work for data.
Getting the ingredients ready?
Precisely. These tools let auditors connect to diverse data sources, clean the data removing errors, inconsistencies, scrub it to address integrity issues, ensure it meets quality standards, maybe normalize it, combine data from different places, summarize it.
Sounds powerful.
And a huge plus is their ability to automate these steps. They can record each ETL process so you can reuse it seamlessly with new data later. Very efficient.
What kind of software are we talking about here?
Examples range widely. You've got everyday spreadsheet tools like Excel, though they have limits. More robust options include database or SQL explorers, specialized data transformation and cleaning software, and even robotics process automation, RPA software, which can automate repetitive data tasks like data entry and extraction.
Okay, ETL tools. What's category 2?
Then we have data modeling software. This is specialized software providing a robust platform for common data analytics procedures.
More focused on the analysis itself.
Exactly. In many cases, these platforms are specifically tailored for common audit analytics. Things like applying Benford's Law analysis.
Benford's Law, what's that?
It's fascinating. It's a mathematical principle about the frequency distribution of leading digits in many real-life data sets. Auditors use it to spot anomalies. Numbers that don't follow the expected pattern can be red flags.
Huh, interesting. Okay, so Benford's Law. What else?
Advanced statistical sampling techniques, things like that. And for more robust or computationally intensive models, auditors might even connect to powerful cloud-based services to leverage their immense processing power.
Examples of this type of software.
Sure. Dedicated data analytics software and plugins, you might hear names like ACL or IDA. Also, data mining software. And for auditors with programming skills, custom programming scripts using languages like Python or R are very common.
Python and R, yeah, hear those a lot in data science. Okay, category 3.
And the third and increasingly critical category is data visualization software. This is where the insights truly come to life and become actionable.
Turning numbers into pictures.
Pretty much. These tools are incredibly useful for creating clear, compelling Charts, graphs, diagrams, interactive dashboards. Their core purpose is to help auditors and stakeholders alike instantly emphasize trends, highlight relationships, illustrate the composition of data, all in a way that's easily digestible and memorable.
Makes sense. A good chart tells a story quickly.
Absolutely. And what's really cutting edge here is that some advanced software can even create sophisticated visuals using simple text prompts. They leverage natural language processing, NLP.
So you just type what you want to see.
Kind of, yeah. Instead of meticulously building every visual from scratch, you tell the software in plain language, show me sales trend by region, and it intelligently generates the visual for you.
Wow. Okay, that's cool. Examples here.
Well, the charts and graphs themselves, obviously, but also dedicated data visualization software like Tableau or Power BI, which are very popular, and as mentioned, those NLP tools that bridge the gap between human language and data graphics.
Okay, tools covered. Now, the techniques themselves, you mentioned a spectrum from simple to sophisticated.
Right. And as a general rule, as the complexity of the technique increases, so does the value and depth of insight it potentially brings to the audit. We can broadly categorize these techniques into 4 types, each sort of building on the last.
4 types. Let's break them down. Type 1.
First up, we have descriptive analytics. This is the most foundational type. It's basically designed to answer the question, what happened, or what is happening with the data.
Just describing the situation.
Exactly. It's all about gaining a high-level understanding. Where's the center of the data? How spread out is it? What's its general shape? Other descriptive values. Key techniques here include summary statistics mean, median for the center, range, standard deviation, variance for the spread, skewness for the shape. You also have correlation to see how variables move together.
Simple stats. Okay. Anything else?
Another common technique is binning. That includes things like frequency distribution, how often certain values pop up, and aging analysis, where you group data into time buckets, like how old accounts receivable balances are to see concentrations.
Okay, descriptive. Let's make it real. You mentioned Kenneth at Tartar Eatery Corp.
Right. Good example. So Kenneth is auditing Tartar Eatery, which has 8 restaurants open Monday through Saturday. Kenneth wants to run some basic summary statistics on their sales transactions. Total sales, average sales per transaction, count of transactions. Simple descriptive stuff.
Okay.
After doing this, he then applies a simple filter to the results, showing only data for Sundays. Remember, the restaurants are supposed to be closed on Sundays.
Ah, looking for exceptions?
Exactly. This lets him quickly see if any sales transactions were recorded on days they were supposed to be closed, and if so, how many and how much. If he finds any, boom, that immediately flags unusual activity. That triggers follow-up, potential additional procedures. Simple but powerful for spotting immediate anomalies.
Got it. Okay, descriptive tells us what? What's next?
Next up is diagnostic analytics. If descriptive analytics tell us what happened, diagnostic is where we start asking the crucial why.
Digging deeper.
Right. These analytics uncover the underlying causes of results. They dig into correlations, patterns, relationships within the data to explain why certain outcomes occurred. Common techniques include clustering, grouping similar data points together, drill down and drill through analysis, diving deeper into specific numbers.
Like clicking on a total to see the details.
Exactly. Also, data mining and discovery to find hidden patterns, variance analysis to explain differences from expectations, period over period analysis to compare trends over time, data profiling to understand data characteristics thematically, and sequence checks to ensure completeness, like checking for missing invoice numbers.
Okay, let's use the Tracy example at Maroney Publishing.
Perfect. So Tracy is reviewing the company's liquidity, a key financial health indicator. She calculates the current ratio for the current year, year 3, and the 2 prior years. She sees it was 1.4 in year 1, 1.5 in year 2, then a significant drop to 0.8 in year 3.
Ooh, that's a big drop. Alarm bells.
Definitely. That requires investigation into the why. So what does she do? She performs a drill-down analysis on that current ratio, breaking out the specific account's current assets, current liabilities for both year 2 and year 3.
Peeling back the layers of the ratio.
Right. She notices most balances are pretty consistent, but there's a huge unexpected increase in short-term debt in year 3. So she drills down again, this time just into the short-term debt account, and she discovers a very large short-term note was issued to acquire new fixed assets.
The reason for the drop.
Exactly. This specific finding then triggers a targeted test of details on that large short-term note transaction. Diagnostic analytics didn't just show a problem, they helped her pinpoint the exact reason for the change.
Very cool. Okay, descriptive, diagnostic. What's third?
Then we elevate to predictive analytics. As the name suggests, this category uses historical data and facts to make predictions, estimates, assertions about future events. It answers the question, what will happen in the future?
Crystal ball time.
Sort of. Key techniques here include regression analysis, which models relationships between variables to predict outcomes, also forecasting, time series modeling to analyze trends and anticipate future values, classification, which categorizes new data points based on learned patterns.
And you mentioned sentiment analysis.
Yes, sentiment analysis is incredibly powerful. It extracts subjective information, opinions, emotions from unstructured text data. Think social media posts, customer reviews.
Okay, let's hear about Elizabeth at SGT Retailers.
Right. Elizabeth is auditing SGT retailers and wants to identify potential fraud risk. She takes an innovative approach. She runs a sentiment analysis on social media posts about SGT's top-selling products.
Mining Twitter for audit clues.
Kind of. She discovers an unusually high level of negative sentiment specifically related to a particular TV model sold only by SGT. That's a red flag.
Okay, people don't like this TV.
So she digs deeper, reviews the transactions for this TV model, notes consistent sales in Q3 and Q4, but very few returns during that period. Seems okay initially, but what's strange is that after year-end, in the following month, there's an abnormal surge of returns for this exact same product.
Huh. Delayed returns. Why?
That timing discrepancy, combined with the negative sentiment, strongly indicates a potential error or maybe even fraud related to the timing of recognizing those returns. Perhaps they were trying to boost year-end sales. Predictive analytics, specifically sentiment analysis, helped her proactively identify a hidden red flag that could point to a material misstatement.
Wow, that's clever. Okay, the fourth and final type.
Finally, we reach the pinnacle with prescriptive analytics. These are the most advanced, most complex. They build on predictive analytics by shifting focus from what will happen to how can we make something happen.
So recommending action.
Exactly. As the name implies, prescriptive analytics actually prescribe courses of action to help optimize decisions and reach desired outcomes. Techniques include what-if analysis, exploring different scenarios, decision support and automation, where systems recommend or even execute actions, machine learning, allowing systems to learn from data and improve recommendations constantly, and natural language processing, NLP, again, allowing computers to understand and process human language, often used to automate text analysis.
Okay, let's look at Petra at Parcel Corp.
Right. Petra's auditing accounts payable. She sees Parcel manually inputs data from physical supplier invoices into their system, a process ripe for human error, right?
Definitely. Typos, missed invoices.
So to improve the audit and maybe suggest improvements to the client, Petra takes a sample of these physical invoices, scans them into digital copies. Then she uses optical character recognition, OCR, and AI application to convert the images into machine-readable text.
Turning pictures of invoices into text data.
Exactly. From there, she employs NLP to intelligently pull specific key information, vendor name, date, amount, PO number, from these converted digital invoices. This extracted data is then automatically matched against the detailed invoice listing already in Parcel's accounting system.
So automating the matching process.
Yes, this whole process lets her quickly and efficiently see if any discrepancies exist between the physical invoices and the system records. It effectively prescribes a more efficient, accurate way to process and review invoices using tech to automate and enhance what was once a very manual control. It finds issues and shows a better way.
Okay, we've covered the types of ADAs and the tools. Now let's see how they really shake things up in each phase of the audit, starting with risk assessment. That seems fundamental.
It absolutely is. Risk assessment is the cornerstone of any effective audit, and ADAs play a truly transformative role here. They really move beyond traditional methods. They help auditors identify previously unidentified risks, assess the risk of material misstatements, big errors at both the overall financial statement level and for specific claims management makes about the data, what we call assertions. And importantly, they are incredibly powerful for identifying and assessing fraud risks.
Finding the fraud flags.
Right, which can often hide in plain sight without this kind of granular data scrutiny. The insights you get from ADAs at this stage are invaluable because they directly help determine what additional audit procedures are needed and where the team should focus their efforts. It's about being proactive, targeted.
Got it. Let's visualize this. You mentioned Costanza Retail.
Yeah, good simple example. The auditor for Costanza Retail has 5 stores in different cities. They want to assess risk by comparing sales across each location quarter by quarter, looking for anything unusual.
Okay, comparing store performance.
They run a simple descriptive ADA, generating a clear column chart showing sales by quarter for each store. Looking at that chart, it immediately jumps out that the Hermitage store had the largest, most unusual change in sales from Q3 to Q4 compared to all the others.
The chart makes the outlier obvious.
Exactly. Based on this direct visual insight, the auditor now has a clear, data-driven signal. Apply more substantive procedures specifically to address the potential risks linked to that dramatic change at the Hermitage location. The data pointed them right where the risk might be lurking. Save time, focused effort.
Makes perfect sense. Okay, from finding risk to checking the safeguards, tests of controls. How do ADAs help there?
They provide significant support and evidence in evaluating both the design and the operating effectiveness of a company's internal controls. This is vital because strong controls are the first line of defense against errors or fraud.
So checking if the system's defenses are working.
Precisely. ADAs can help test controls in several ways. They can evaluate external data to validate control outcomes like matching shipping data to sales records. They can analyze internal data to either corroborate or dispute the effectiveness of controls. They're excellent at scanning huge data sets for anomalies that are likely the result of a control failure.
Catching when a control breaks down.
Right, flagging exactly when it didn't work as intended. And they can also powerfully aid in reperformance activities where auditors basically redo a control process themselves to see if it functions correctly and consistently.
Okay, the Tillman Financial example sounds interesting, especially the fuzzy logic part.
Yeah, that's a good one. Tillman Financial has a critical control. Make sure all employees who left in the past year, quit or fired, had their system access revoked immediately. Super important for security.
Critical control, yeah.
The auditing company uses a diagnostic ADA with fuzzy logic capabilities. Now, fuzzy logic, simply put, allows for an approximate search. It's smart searching.
Not just exact matches.
Right. If you search for John Smith, it might intelligently return Smith John with a 99% match. It accounts for variations in data entry, typos, swapped names.
Handles real-world messy data.
Exactly. So, by comparing a list of discharged employees with a list of those who still have active system access, the auditor runs this fuzzy logic ADA. It helps determine if any access was not removed appropriately, even if the names don't match perfectly. This uncovers potential control failures related to system access, enhancing data security.
Clever use of tech there.
Yeah.
Okay, next up, substantive procedures. You call this the meat and potatoes.
It often is. This is where auditors detect material misstatements in the financial statements and disclosures at the assertion level. ADAs are incredibly well suited for both parts of this: tests of details and analytical procedures.
Let's break down tested details first. What are those again?
These are performed on individual transactions and balances to get direct evidence supporting the values and disclosures. Think verifying specific invoice amounts or confirming bank balances.
Okay, how do ADAs fit in?
In really powerful ways. They can perform sequence checks on pre-numbered documents, like invoices or checks, across entire populations to ensure completeness, looking for gaps or duplicates that might signal missing or fake entries.
Finding missing invoice numbers automatically.
Exactly. They can test entire populations to verify accuracy, literally eliminating sampling for certain tests and giving 100% assurance on accuracy for specific assertions. Auditors can also compare transactions against external data like matching sales to shipping manifests to ensure they actually occurred and were recorded accurately.
Verifying against outside sources.
Right. And finally, they can use structure and content analyses to evaluate source data, identifying missing data fields or inconsistent formatting that could point to system or process problems.
Okay, that's tests of details. What about analytical procedures?
This is a really natural and powerful fit for ADAs. Analytical procedures involve evaluating financial info by analyzing plausible relationships between data, both financial and non-financial.
Looking for relationships and expectations.
Precisely. ADAs enhance these procedures significantly. They can be used for comparing current year data to prior year data to spot trends or anomalies. They're great for comparing industry trends to the client's trends, giving crucial context. They are critical for developing robust expectations for transaction or balance amounts, using techniques like regression, period-over-period analysis, trend analysis, classification, ratio analysis.
Building a prediction of what the number should be.
Exactly. And if significant differences pop up between the expected amount and the actual amount, ADAs then allow for immediate, efficient drill-down analysis to investigate those specific variances and find the root cause.
Let's use the Heenan Auto example. 12 mechanic shops.
Right. Heenan Auto runs 12 shops. The auditor runs a regression ADA. They suspect gross revenue can be accurately predicted by two main drivers: labor hours worked and materials expended.
Makes sense for a mechanic shop.
The ADA uses 3 years of historical data and confirms this assumption is correct. It establishes a strong predictive model. The auditor then uses this model's output to set clear, data-driven expectations for the current year's revenue for each of the 12 shops.
So a custom prediction for each shop.
Yep. Then they compare the actual results against these predictions. This helps them quickly pinpoint any shops or periods where revenue significantly deviates from the model's prediction. That deviation signals a potential misstatement or operational issue needing targeted investigation. It's incredibly efficient for pinpointing risk across multiple locations.
Very efficient. Okay, last phase. Concluding the audit. How do ADAs play a role right at the end?
Towards the very end of an audit, the auditor has gained this incredibly deep knowledge of the client and its environment. This refined understanding lets them apply ADAs again, similar to how they're used in initial risk assessment, but now with a much more informed, insightful perspective.
Like a final check with all the knowledge gained?
Exactly. Using ADAs at this crucial stage helps the auditor gain that final layer of comfort and assurance that no material misstatements slipped through the cracks during the audit. It's that final sweep, providing incredible value.
It's like that final pass with a very smart, digitally enhanced fine-tooth comb, making sure nothing was missed.
That's a perfect analogy. And these concluding procedures might also involve applying ADAs to updated financial figures or disclosure info discovered or adjusted during the audit.
Accounting for last-minute changes.
Right. Those updates, even minor ones, could affect trends and ratios observed earlier. The ADA helps reevaluate the overall picture with the most current data, providing a dynamic final check before signing off.
We've talked a lot about the incredible power of ADAs, how they transform the audit. But here's the absolute, undeniable truth, right? Audit data analytics are only as brilliant, as revealing, as the data you feed them.
Couldn't have said it better myself. It brings us squarely to the critical importance of data quality.
Garbage in, garbage out.
It's the classic garbage in, garbage out principle, but amplified because of the scale and complexity. It is absolutely vital that the data used for ADAs is complete, accurate, relevant, and crucially, reliable.
So auditors need to be data detectives too.
In a way, yes. They must meticulously identify what specific data is needed for a specific ADA, where and how that data can be reliably sourced from the client systems, and what procedures need to be performed to ensure its reliability and integrity before any meaningful analysis can even begin.
Okay, so where does all this critical data actually come from? Businesses use tons of different systems, right?
A vast and diverse array. We're talking everything from core accounting information systems, AIS, management information systems, MIS, executive information systems, EIS, decision support systems, DSS, customer relationship management systems, CRMs.
CRM data for an audit.
Absolutely. Think customer complaints, sales patterns, also supply chain management, SCMs, inventory management systems, IMS, knowledge management systems, KMS, and of course, comprehensive enterprise resource planning, ERP systems that try to integrate many of these, all generate and store massive amounts of potentially useful data.
So data lives in lots of different places. How is it stored? Is it all just one big database?
Rarely that simple. Data can reside in a number of different data repositories. Think of it on a spectrum, from the most raw and least structured to the most refined and organized.
Okay, walk us through that spectrum.
At one end, you have a data lake. It's like a vast reservoir where all data, structured and unstructured, is stored in its raw format, just waiting to be processed.
Like a real lake, just holding everything.
Pretty much. As data gets more organized for analysis, it might move into a data warehouse. This contains structured, organized database tables specifically designed for analysis across the whole enterprise.
More organized, like a warehouse.
Right. Then you might have a data mart, which is a smaller, more focused subset of a data warehouse, tailored for specific business segments or departments like just the sales data mart.
A smaller specialized section.
Exactly. And then you have highly structured databases containing tables with attributes and records designed for very specific analyses. Auditors might pull data from any of these storage functions, and each presents unique challenges and opportunities for an ADA.
Okay, systems and storage. What about other sources? Financial statements themselves?
Definitely. Data comes from various internal and reporting sources, too. The audited financial statements, detailed transaction logs, subledgers, and general ledgers providing granular detail, original source documents like invoices, purchase orders, receiving reports.
Paper documents still matter?
Sometimes the source is still paper or scanned images of paper, yes.
So
Also, standalone data files like various spreadsheets and increasingly data flowing in from connected devices, the Internet of Things or IoT.
IoT data. Like, wait,
Think sensors tracking inventory movement in a warehouse in real time or GPS data from a delivery fleet showing routes and times, all potentially relevant.
wow, the sources are really expanding. What about outside the company? External data.
Absolutely crucial. We mustn't forget external sources. Auditors frequently get data from governmental sources like public records, private external sources like industry benchmarks or credit rating agencies, and critically, from service organizations, think cloud computing providers hosting client data or processing payroll.
Right. Lots of companies use third-party services now.
Exactly. These external data points can provide incredibly valuable corroboration or context, especially when you cross-reference them with internal data.
Okay, so when auditors get this data, how does it usually arrive? What file formats are common?
They often receive it in various formats, each with pros and cons. Very common are straightforward formats like tab-separated text.txt files and comma-separated value.csv files.
Simple text files.
Right. They're universally accepted, efficient for moving large data sets, often avoiding row limits you might find in spreadsheets. Then there's the familiar Microsoft Excel.xlsx spreadsheet. Still everywhere, flexible for quick analyses, but yeah, it has size limitations.
Can't put millions of rows in Excel easily.
Not easily, no. More structured are database files like .db or Microsoft Access's .accdb. These let auditors move data into a database environment for more robust relational analyses.
Okay, what about more advanced formats?
You might see extensible markup language .xml files. These are more hierarchical, contain rich metadata about each data element, making data sharing easier between different applications. Then there are hypercube.hyper files, often used by visualization tools like Tableau. They can sometimes allow for automated updates of linked audit documentation if the underlying data changes, a big efficiency win.
Automated updates. Nice.
Yeah. And finally, simple compressed.zip files, just to make sharing large files easier and save storage space.
Makes sense. Okay, now a really important distinction you mentioned. Structured versus unstructured data. Why does that matter so much?
It's hugely important because it fundamentally changes how you approach the analysis and the tools you need.
Okay, let's start with structured data. What defines that?
Structured data is the organized, predictable type. It has consistent data types, formats, and it's easily searchable using query languages like SQL. You typically find it in spreadsheets, tables, databases, data cubes, data marts, data warehouses, the organized end of the spectrum we talked about.
The neat and tidy data.
Pretty much. A key feature, especially in relational databases, is how it organizes info into records, rows, and attributes, columns. Understanding concepts like primary keys, the unique ID for each record, like a customer ID.
One unique code per customer.
Right, and foreign keys, these are the crucial links that connect records between different tables. For example, that customer ID appearing in a sales order table links that order back to the main customer table.
Connecting the tables together.
Exactly. For auditors, this means we can leverage these keys to stitch together seemingly separate data sets, getting a holistic view. Like seeing all sales for one customer, no matter where that data lives in the client system. It allows for powerful cross-referencing.
Got it. Keys link everything. You also mentioned normalization. Sounds technical.
It is a bit technical, but the concept is important. Normalization is a database design technique to reduce data redundancy, unnecessary repetition. It does this by dividing large tables.
Like that massive sales order table you mentioned earlier, with all the customer info repeated.
Exactly like that. It divides large tables like that into smaller, more efficient tables that are then linked together using those foreign keys. This makes relational databases incredibly effective at reducing duplication and improving data integrity. It keeps the data cleaner.
Can you give a simple example? The college student one?
Sure. Imagine an auditor wants info on 10 college students' name, address, high school, and the courses they've signed up for. Each student signed up for 3 courses. In a simple flat spreadsheet, you'd have 30 records, right? 10 students times 3 courses.
Okay, 30 rows.
But student A, who took 3 courses, would have 3 separate rows, and each of those rows would repeat their name, address, high school. Lots of duplication.
Very inefficient.
Very. A normalized relational database would restructure this. You'd have maybe 3 smaller linked tables, one for student roster with student ID as primary key, one for the course catalog, course ID and one enrollment summary table linking student IDs to course IDs.
Bringing it down.
Exactly. That process of breaking down the large redundant data set into multiple smaller linked tables is normalization. Makes the data much more organized, efficient, and easier to analyze without all the repetition.
Okay, that makes sense. Now the other side, unstructured data, the wild frontier.
Good way to put it. Unstructured data is essentially all data that isn't structured. It's typically in its original raw format and stays that way until it's transformed for analysis. It's not organized, its format and data type are inconsistent, making it very difficult to sort. It often requires different ADAs and specialized tools.
Where do you find this stuff?
This is the kind of data typically accumulating in those vast data lakes we mentioned.
Examples.
Oh, lots. Social media posts rich with sentiment, interview or phone call transcripts, just raw text, data from sensors, IoT, continuous streams of raw measurements, even videos or images.
How do you analyze a video for an audit?
It requires sophisticated tools, often AI and machine learning, to extract meaningful insights, maybe object recognition and security footage or analyzing audio tracks. The challenge is extracting value from its raw, inconsistent format.
Fascinating. Okay, besides structured, unstructured, you mentioned data attributes. What are those?
Attributes are just the characteristics of the data. Understanding them is crucial because it impacts the type of analysis you can do. We can broadly categorize data into 4 types based on attributes.
4 types of attributes. Go.
First, numeric, quantitative data. Describes quantity, counts, financial values, revenue, transaction counts. It can be discrete, whole numbers, like employee headcount, or continuous, can have decimals fractions, like dollar amounts or measurements.
Okay, numbers.
Second, text, qualitative data. Provides descriptive values, customer survey responses, call transcripts, social media posts, might identify categories, geographic regions, or represent a rank or order, income level, job title.
Words and descriptions.
Third, date and time data. Straightforward but powerful for trends. When things happen years, quarters, month, specific dates, even times of day.
Right.
And fourth, geographic data, where operations occur, address, city, state, zip code, even precise latitude, longitude, allows for spatial analysis.
Where? Okay, number, text, when, where. Got it. Now, the big question, once you've all this data, how do you ensure you can trust it? Reliability.
Crucial question. This brings us to data reliability verification. Since most data comes from information systems, the audit typically involves performing general IT controls, GITC testing.
EITs.
General IT controls. These are controls over the IT environment itself, things like access security, change management, system operations. If the controls around the system and its data are weak, the data coming out simply might not be reliable enough to base an audit conclusion on. It's a foundational check.
So check the system's health first. What else do auditors do to verify data reliability?
A whole battery of procedures. They might obtain or create flowcharts or data flow diagrams to really understand the data's journey from source to report. They perform tests of control specifically around how that internal data is processed. They use confirmations to verify balances directly with third parties, banks, customers, vendors, getting independent corroboration.
Asking outsiders to confirm.
Right. They may recalculate provided data or reperform how the data was produced to check accuracy. As mentioned, they test GITCs. If key data is in spreadsheets, they'll meticulously evaluate spreadsheet controls because spreadsheets can be risky if not controlled well.
Yeah, easy to make errors in Excel.
Very easy. They might also request a SOC1 report if data comes from an external service organization, like a cloud provider, to get assurance over their controls. If possible, they'll compare the data with a separate internal source or even an external entity for consistency.
Cross-checking everywhere.
The most reliable data is often when the auditor sources the data directly from an independent external party, minimizing client handling. They'll perform sequence tests on pre-numbered documents for completeness. They validate source data using totals, batch totals, hash totals, record counts, ensuring nothing got lost or corrupted during transfer. And they run summary statistics and check if the outcomes make sense based on expectations or known financial relationships.
So lots of checks and balances.
Absolutely. Auditors also meticulously review known relationships in financial statements, like making sure beginning balances roll forward correctly to ending balances. They reconcile data at different levels, transactions to subledgers, subledgers to the general ledger, GL to the financial statements. And sometimes for really complex or specialized data, they'll employ specialists, internal audit, forensic accountants, IT auditors, external experts to bring the necessary expertise.
Okay, let's use the Sherman CPA example at Reagan Phillips Financial. Testing equity.
Right. Sherman CPA is testing equity accounts. To ensure reliability, they start with fundamentals, reconciling beginning retained earnings to the ending balance for the year, factoring in net income and dividends. They validate dividends with an external stock regulator, review tax records for net income. Basic checks confirm the core equity data seems accurate.
Standard stuff.
But then, Sherman calculates the debt-to-equity ratio for the current and prior year and sees a drastic 45% increase year over year. Huge jump. That's a red flag. Prompted by this, Sherman runs a classification analytic. This advanced technique looks at the financial ratio profiles of companies in the same industry that recently went bankrupt and compares them to Reagan Phillips Financial's current profile.
Comparing them to bankrupt companies. Wow.
Yeah, to assess its bankruptcy risk based on similar patterns. The initial reliability procedures confirmed the basic data was okay, but the analytical technique then revealed a deeper potential risk that required immediate, targeted investigation.
Shows how reliability checks and analytics work together.
Perfectly. And just to wrap up on reliability, some factors inherently make data more reliable. Evidence is better if the auditor sourced the data directly, not just got it from the client. Data from an independent source is better. If controls around the data are effective, that's better. Original documents are better than copies. And documented evidence is always, always better than just relying on conversations. It's all about building that chain of trust in the data.
Okay, so we've gathered the data, cleaned it, analyzed it, made sure it's reliable. But what's the point if you can't actually see the story, understand the insights clearly? This brings us to the crucial final stage, making sense of it all through powerful visualizations and expert interpretations.
Absolutely. The ultimate value, the efficacy of an ADA, is utterly dependent on how well its output helps the auditor quickly gain insights, provide compelling audit evidence, and precisely identify those important relationships, underlying trends, or critical anomalies.
The output has to be useful.
Right. And remember, evaluating this output is often an iterative process. You might find the technique, its performance, maybe even the data itself needs more work, refinement, possibly leading to rerunning the analysis until it yields the most reliable insights.
Keep tweaking until it's right.
Exactly. But once the ADA is deemed appropriate, then comes the magic. Data visualizations. These are integral to how analytics are performed and interpreted today. They take complex activities or vast amounts of data and transform them into easy-to-read graphs, charts, intuitive visuals.
Making the complex simple to see.
Precisely, providing the auditor with immediate, actionable insights to make informed decisions.
But creating good visuals isn't automatic, right? There are pitfalls, ethical considerations.
Oh, definitely. There are critical considerations to ensure visuals are both ethical and effective, preventing misinterpretation or bias. First, you must choose the right type of visualization for the story.
Like, don't use a pie chart for a time trend.
Exactly. A pie chart, a scatter plot, a line chart, they tell very different stories. Using the wrong one can distort the message or hide the real insight. Second, absolutely vital. Apply correct scaling. Typically, the y-axis, the vertical one, should start at 0.
Why 0?
Because if you truncate the scale starting at higher, you can make small differences look huge, or vice versa. It's a common visual trick, intentional or not, that auditors must avoid to present data fairly.
Good point. What else?
Third, utilize appropriate colors. Colors profoundly affect interpretation. Red often means danger or loss. Green means good. You have to consider the audience. Cultural context colors can have different meanings globally. Keep it clear and consistent.
And avoid making it look like a confusing rainbow.
Please. And finally, emphasize focus areas responsibly. While visuals can be manipulated to draw the eye to specific outcomes, it's essential they're designed to focus on the ADA's objective, avoiding bias. Clarity and accuracy, not persuasion, are the goals.
Makes sense. Okay, let's talk about interpreting some key visuals. First, regression analysis.
Okay, purpose. Regression evaluates relationships between variables. Simple regression shows direction and strength, like, is office supplies expense driven by labor hours? Visual, usually scatter plots. Data points plotted with an XY relationship, plus a regression line showing the predicted relationship. Interpretation. If there's a strong correlation, points cluster tightly around the line, or you get a high R-squared value. If it's strong, the auditor can use the output to set expectations. Points far from the line outliers might trigger more procedures.
Okay, scatter plots for relationships. Next, variance analysis.
Right. Purpose. Comparing forecasted or budgeted values against actuals. Key for checking performance against expectations. Visual. Bullet charts are great here. They show actual bar values against lines marking the budget or target. Quick visual comparison. Interpretation. Auditors often set an acceptable margin of error, say plus minus 10%. The chart can highlight this zone. You pay closest attention to values significantly outside that margin, those need investigation. You can see in a typical actual versus budget chart how quickly those big variances pop out.
Bullet charts for budget versus actual. Got it. Period over
Okay.
period analysis.
Purpose. Comparing financial or non-financial values across periods, like Q1 this year versus Q1 last year, looking for trends or shifts. Visual. Bar or column charts work well for comparing values side by side across periods. Easy visual review. Interpretation. Significant differences jump out and need explanation. Auditors might also check if related accounts move logically together, like sales and cost of goods sold both increasing. If things diverge unexpectedly, drill down to find the cause. That net income by quarter chart clearly shows year one versus year two differences, prompting the why.
Bar charts for comparing periods. Okay, classification.
This one's predictive. Purpose. Uses historical data to predict which category a new data point fits into, like identifying transactions as high fraud risk based on past patterns. Visual. Scatter plots can show where values fall relative to different classes, or visuals showing proportions like pie charts or tree maps, giving a quick overview of the category breakdown. Interpretation. Most data points should fall clearly into one class or another. Auditors focus on the outliers' values that don't clearly fit with their neighbors. These suggest complexity, potential misclassification, and need more judgment and investigation. You might see this in a net income versus revenue scatter plot or a sales by state pie chart where one slice is unexpectedly large or small.
Scatter plots or pie charts for categories. And finally, trend analysis.
Very common. Purpose. Develop expectations of future results. Also comparing internal trends or benchmarking against industry external data. Visual. Line charts are best. They naturally show the forward movement of time, making trends intuitive. Interpretation. Inconsistencies with comparative trends signal further investigation. Look for trends moving logically together, sales and Kaji up. If a trend line is very volatile, maybe drill up or down the timeline, monthly to quarterly. To smooth it out, look for seasonality or investigate abnormal patterns. The net income trend line chart shows that tracking over time, spotting dips or spikes.
Line charts for trends over time. Perfect. So what happens when these visuals reveal something off? An outlier, a weird variance. What does the auditor do?
Great question. When reviewing AD output, you often find items outliers, abnormal variances, unexpected results that could indicate potential misstatements and definitely need attention. If there are many such items, auditors often group them strategically to make the review manageable.
Okay, group them. Then what?
They generally divide these items into two broad categories based on potential impact. First is clearly inconsequential.
Meaning too small to matter.
Essentially, yes. The auditor determines these items don't pose a risk of material misstatement, either individually or when added up with other small items. In this case, they simply document why they're inconsequential, the amounts, the nature of the item, and move on. Saves time by filtering out the noise.
Okay, filters out the small stuff. What's the other category?
The second and far more critical category is not clearly inconsequential. When possible misstatements found are not clearly trivial, the auditor must perform additional rigorous steps.
Okay, what steps?
First, group these items by common characteristics, maybe they all happened in the same month, have similar dollar values, relate to the same type of transaction or control failure, then critically determine the specific possible misstatements indicated. After that, more analysis, procedures, and review are needed to see if these groups ultimately contain no actual misstatements, or maybe misstatements that are now clearly inconsequential, or if they still represent misstatements that are not clearly inconsequential individually or in aggregate.
A deeper investigation.
Right. And this whole step needs thorough documentation, the rationale, the findings, any items that, after all this, still remain not clearly inconsequential, trigger what we call additional procedures.
Okay, additional procedures. Sounds serious. What does that involve?
This is where the real deep dive into potential problems happens. Auditors roll up their sleeves. The nature and extent vary hugely based on judgment and context, but they generally address several key areas.
Like what?
The auditor must consider both quantitative dollar amount and qualitative factors, the nature, context, potential implications. A small dollar error could still be significant if it indicates fraud, for instance.
Right, context matters.
There must be an immediate assessment for potential fraudulent activity. ADAs are great at flagging anomalies that could be fraud, so this is paramount. They evaluate if the issue might stem from a control or process failure, addressing the root cause. And finally, they determine the scope of the substantive procedures needed now. Should they test the entire population related to the finding or just a targeted sample? It's a precise, risk-based response triggered by the ADA finding. Hashtag tag tag outro.
Wow, what an incredible journey into the heart of modern auditing. From defining audit data analytics and really getting a handle on their benefits,
Which are pretty revolutionary.
totally, to exploring the powerful digital tools and clever techniques involved, and then seeing them in action across every critical phase: risk assessment, controls testing, substantive work, even concluding the audit. It's crystal clear how ADAs are truly enhancing audit quality and efficiency.
It really is evident that ADAs aren't just some add-on or passing trend. They are fundamentally transforming how auditors approach their work. They provide deeper insights, far more comprehensive assurance than we ever had before.
We truly hope this deep dive has equipped you, our listeners, with a strong, practical understanding of this cutting-edge and, let's face it, rapidly evolving field.
Yeah, things are moving fast.
Absolutely. And as you look ahead, here's something to chew on, a provocative thought. As data continues its exponential explosion and artificial intelligence advances at breakneck speed, how might these powerful audit data analytics evolve even further?
Where could it go next?
Could they one day, maybe, predict and proactively prevent financial issues before they even become problems? Truly transforming the very landscape of financial assurance into something almost prescient.
That's a truly thought-provoking idea to end on. The future of auditing is definitely going to be exciting to watch.
We agree. Thank you so much for joining us on this deep dive into audit data analytics. We hope you learned something new, insightful, and maybe even a little exciting.
Hope it was useful.
Until next time, keep exploring, keep questioning, and always stay curious.